Preparing for a Wells Fargo Quantitative Analyst interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. How would you explain value at risk, and what are its main limitations? VAR estimates the loss threshold that a portfolio should not exceed over a chosen horizon and confidence level. I would calculate it historically, parametrically, or through Monte Carlo simulation. For example, one-day 99% VAR describes a loss exceeded on roughly one trading day out of 100. Its weakness is that it says little about losses beyond the threshold and can behave poorly with nonlinear positions. I would complement it with expected shortfall, stress tests, and scenario analysis. While answering, define VAR clearly, distinguish historical, parametric, and Monte Carlo approaches, explain confidence level and horizon, and discuss non-additivity, tail risk, liquidity assumptions, and expected shortfall. Question 2. How would you price a European call option using the Black-Scholes model? I would use Black-Scholes by inputting spot price, strike, maturity, risk-free rate, dividend yield, and volatility. The formula discounts the expected payoff under a risk-neutral measure, using cumulative normal probabilities of D1 and D2. Before trusting the result, I would check units, put-call parity, and limiting cases such as zero volatility. The model assumes continuous trading, log normal prices, constant volatility, and frictionless markets, so I would compare it with implied volatility surfaces for production pricing. Make sure to cover model assumptions, inputs, risk-neutral valuation, D1 and D2, volatility, dividends, boundary conditions, and limitations involving early exercise, stochastic volatility, jumps, and liquidity. Question 3. What is the difference between historical and Monte Carlo simulation for risk measurement? Historical simulation replays observed market moves, so it is intuitive and relatively assumption-light, but it depends heavily on the chosen window and may miss unprecedented regimes. Monte Carlo generates many hypothetical scenarios from calibrated factor models, handling nonlinear portfolios more flexibly but introducing model risk and computational expense. At Wells Fargo, I would use both, historical results for transparency and Monte Carlo for complex exposures, then compare forecasts through backtesting and stress scenarios. In your answer, compare data dependence, distributional assumptions, computational cost, nonlinear instruments, scenario generation, calibration, backtesting, and the importance of validating model outputs. Question 4. How would you test whether a trading strategy has statistically significant performance? I would first separate training, validation, and genuinely untouched test periods. Then I would evaluate risk-adjusted returns after commissions, spreads, market impact, and financing costs. A high Sharpe ratio alone is insufficient because returns may be autocorrelated and the strategy may have been selected from many trials. I would use bootstrap or block bootstrap confidence intervals, test robustness across regimes, and check for look-ahead and survivorship bias before considering deployment. Be sure to mention out-of-sample testing, Sharpe ratio uncertainty, hypothesis testing, multiple comparisons, transaction costs, look-ahead bias, survivorship bias, autocorrelation, and realistic portfolio constraints. Question 5. What is duration, and how would you use it to measure bond price sensitivity? Duration measures a bond's sensitivity to yield changes. Modified duration gives the first-order approximation. Percentage price change is approximately negative modified duration multiplied by the yield change. Longer maturities and lower coupons usually create greater sensitivity. For larger rate moves, I would add convexity because the price-yield relationship is curved. I would also use key rate durations when exposures to specific maturities matter, especially for portfolios with non-parallel yield curve movements. Focus on Macaulay and modified duration, yield changes, first-order approximation, convexity, cash flow timing, and limitations for callable, floating rate, or highly nonlinear bonds. Question 6. How would you construct and validate a yield curve from market instruments? I would select liquid deposits, futures, and swaps across maturities, convert their quoted rates into consistent cash flows, and bootstrap discount factors sequentially. Every instrument must use correct calendars, day count rules, payment conventions, and settlement adjustments. I would choose an interpolation method that behaves sensibly for discount factors or zero rates, then reprice the input instruments. Finally, I would monitor residuals, curve smoothness, liquidity effects, and extrapolation risk rather than relying on a visually attractive curve. Cover instrument selection, bootstrapping, discount factors, interpolation, day count conventions, settlement dates, no arbitrage checks, liquidity, extrapolation, and validation against independent market quotes. Question 7. Explain principal component analysis and its use in fixed income risk management. PCA decomposes correlated yield changes into orthogonal factors ranked by explained variance. In a yield curve, the first components often resemble level, slope, and curvature movements. I would estimate the covariance matrix from historical changes, compute eigenvectors, and project portfolio sensitivities onto those factors. This reduces monitoring complexity and highlights concentrated risks. However, PCA is sample-dependent and may miss stressed behavior, so I would combine it with key rate durations and deterministic scenarios. In your answer, describe covariance construction, eigenvectors, explained variance, level slope curvature interpretation, dimensionality reduction, stability concerns, and how PCA complements rather than replaces key rate analysis. Question 8. What is the purpose of stress testing in a bank's quantitative risk framework? Stress testing asks how a portfolio, business, or balance sheet performs under severe but plausible conditions. I would combine historical episodes, such as rate shocks, spread widening, and equity declines, with hypothetical scenarios tailored to current exposures. The analysis should capture nonlinear effects, defaults, liquidity constraints, and interactions across risk types. Results support capital planning, limits, and contingency actions. Stress tests do not predict probabilities perfectly, they reveal vulnerabilities that normal distribution models can overlook. Mention plausible but severe scenarios, historical and hypothetical shocks, nonlinear portfolio effects, capital and liquidity impacts, reverse stress testing, governance, and limitations of relying only on statistical models. Question 9. How would you use backtesting to evaluate a VAR model? I would compare each day's realized portfolio loss with the model's VAR and record exceptions. At a 99% level, approximately 1% of observations should exceed VAR, subject to sampling variation. I would test both the number and independence of exceptions because clustered breaches indicate changing volatility or dependence assumptions. If the model fails, I would investigate data quality, sensitivities, stale prices, and calibration, then recalibrate or escalate limits rather than simply increasing the VAR multiplier. Make sure to discuss exception counting, confidence level expectations, independence, clustering, traffic light interpretations, conditional coverage, model remediation, and the distinction between statistical adequacy and economic usefulness. Question 10. What is expected shortfall, and why can it be preferable to VAR? Expected shortfall is the average loss conditional on losses exceeding a selected VAR threshold. Unlike VAR, it describes the severity of tail outcomes and is generally coherent, meaning diversification behaves more consistently under suitable conditions. I would estimate it through historical, parametric, or Monte Carlo methods, depending on the portfolio. Its estimates can be noisy, especially at high confidence levels, so I would use sufficient simulations, tail diagnostics, stress scenarios, and sensitivity analysis before using it for limits. Explain tail loss averaging, coherence, confidence level, estimation challenges, liquidity effects, scenario dependence, and why expected shortfall should be supported by stress testing and robust data controls. Question 11. How would you value a collateralized interest rate swap under a risk-neutral framework? I would project each floating leg payment using the appropriate forward curve, calculate fixed and floating cash flows, and discount them using the collateral consistent discount curve. The swap value is the present value of received cash flows minus paid cash flows, with sign depending on the position. I would include payment timing, calendars, day counts, collateral terms, and netting sets. For bilateral exposure, I would then consider CVA and other adjustments, validating the result against market par rates. Cover discounted expected cash flows, forward rates, discount curves, collateral remuneration, payment schedules, netting, calibration, credit valuation adjustments, and consistency between projection and discounting curves. Question 12. What are Greeks, and how would you use them to manage derivatives risk? Greeks measure how a derivative's value responds to market inputs. Delta captures first-order price exposure, gamma captures curvature, vega measures volatility sensitivity, theta reflects time decay, and rho measures interest rate sensitivity. I would aggregate them across positions, monitor concentration by underlying and maturity, and supplement them with shocked revaluation because linear Greeks can miss large moves. For unstable numerical Greeks, I would use carefully chosen finite differences or automatic differentiation and verify signs against intuition. Discuss delta, gamma, vega, theta, and rho. Explain first and second order effects, aggregation, scenario testing, numerical stability, and limitations when models or market inputs change materially. Question 13. How would you detect and handle multicollinearity in a regression model for credit risk? I would inspect pairwise correlations, condition numbers, and variance inflation factors, then assess whether coefficients change dramatically across samples. Multicollinearity inflates standard errors and makes interpretation unreliable, even when predictions look acceptable. Possible remedies include removing redundant variables, combining economically related features, using principal components, or applying ridge regularization. I would select the approach based on the model's purpose. Prediction may tolerate shrinkage, while regulatory or credit decisions often require transparent, stable drivers and strong out-of-sample validation. In your answer, mention correlation matrices, variance inflation factors, coefficient instability, regularization, feature selection, principal components, interpretability, out-of-sample validation, and avoiding leakage from future information. Question 14. How would you build a probability of default model for commercial borrowers? I would define default precisely, including the performance window and treatment of restructurings, then assemble financial, behavioral, industry, and macroeconomic variables available before the prediction date. I might begin with logistic regression for interpretability, using monotonic transformations and regularization, then compare stronger alternatives. Evaluation should include AUC, precision recall, calibration, stability across segments, and economic backtesting. I would document exclusions, address class imbalance, monitor drift, and ensure decisions remain explainable and fair. Cover target definition, observation window, financial and behavioral features, logistic regression or alternatives, class imbalance, calibration, discrimination, reject bias, monitoring, explainability, and regulatory validation. Question 15. What is the difference between correlation and covariance, and why does it matter in portfolio construction? Covariance measures how two variables move together in their original units, while correlation standardizes covariance to a range from -1 to 1. Portfolio variance uses covariances, so a poor covariance estimate can create misleading allocations and risk forecasts. Correlation helps compare relationships across assets, but it is not causation and can change during stress. I would use rolling diagnostics, shrinkage or factor models, and scenario analysis to improve stability rather than trusting one historical matrix. Explain scale dependence versus normalization, covariance matrix estimation, diversification, portfolio variance, unstable small samples, shrinkage, factor models, and the danger of assuming correlation implies causation. Question 16. How would you implement a Monte Carlo simulation efficiently in Python? I would generate simulated risk factors in vectorized NumPy arrays rather than looping through individual paths, then apply pricing functions across batches. I would set explicit random seeds for testing, use antithetic or quasi-random sequences when appropriate, and monitor convergence of estimates and confidence intervals. For large portfolios, I would batch paths to control memory and parallelize independent workloads carefully. I would profile before optimizing, validate against analytical cases, and keep model, simulation, and reporting layers separate. Be sure to mention vectorization, random number reproducibility, variance reduction, numerical stability, memory management, parallelization, convergence checks, and separating simulation logic from valuation and reporting. Question 17. How would you investigate a large unexplained change in a daily risk report? I would first confirm whether the move is real by reconciling positions, prices, curves, volatilities, and prior day data. Next, I would decompose the change into market, new trade, model, and unexplained components using sensitivities and independent repricing. I would check recent code, configuration, data feed, and corporate action changes, then compare with another risk engine or desk estimate. If material, I would escalate promptly, preserve the original report, document root cause, and rerun only after controls are satisfied. Discuss data lineage, market moves, position changes, pricing inputs, sensitivities, limit breaches, reconciliation, code changes, independent checks, escalation, and documenting root cause before rerunning production outputs. Question 18. What is model risk, and how should a bank manage it? Model risk is the possibility that a model produces harmful decisions because its theory, data, implementation, or use is wrong. I would manage it through clear documentation, independent validation, benchmark comparisons, sensitivity and stress testing, code review, and controlled releases. Models should have defined limitations, owners, performance thresholds, and monitoring dashboards. When assumptions are weak, I would apply conservative overlays or usage restrictions. Strong governance matters as much as mathematical sophistication, particularly in regulated banking. Focus on incorrect assumptions, implementation errors, data limitations, validation independence, benchmarking, sensitivity analysis, documentation, governance, change control, monitoring, and compensating controls for known weaknesses. Question 19. Describe a time you would need to communicate a complex quantitative result to non-technical stakeholders. I would lead with the decision impact rather than equations. For example, projected stress losses exceed the current limit under a specified rate scenario. Then I would show one clear chart, explain the primary drivers, state uncertainty and assumptions, and distinguish observed facts from model estimates. I would recommend an action, such as reducing duration or increasing capital, and invite challenge. If stakeholders need technical detail, I would provide an appendix without obscuring the main message. In your answer, emphasize business impact first, plain language, visual summaries, assumptions, uncertainty, actionable recommendations, audience adaptation, questions, and avoiding unsupported precision or unnecessary mathematical detail. Question 20. Why do you want to work as a quantitative analyst at Wells Fargo, and how would you add value? I am interested in Wells Fargo because quantitative work directly supports pricing, risk management, capital decisions, and responsible financial products at significant scale. I would bring strong probability, statistics, programming, and numerical modeling skills, while staying conscious of data quality and model limitations. My approach is collaborative. Understand the business problem, build a transparent solution, validate it independently, and communicate results clearly. I would aim to deliver models that are accurate, maintainable, auditable, and useful to decision makers. Mention quantitative rigor, risk-aware banking, model validation, collaboration with trading or risk teams, production quality coding, regulatory responsibility, communication, and a specific example of measurable analytical value. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.